Have you ever wondered why one US dollar can buy hundreds of units of another country's currency, while another currency is actually worth more than the dollar itself? Why does one British pound equal more than a dollar? Why is the Japanese yen worth less than a cent? Why is the Nigerian naira weaker than many global currencies? And why do currency values constantly rise and fall every single day? Most people think currency values are random, but they are not. Behind every currency value is a powerful story about economics, trade, politics, resources, trust, debt, inflation, productivity, and global power. In today's video, we're going deep into the fascinating world of money to understand why different currencies have different values. By the end of this video, you will understand what gives money value, why some currencies are strong while others are weak, why governments cannot simply print unlimited money, how inflation destroys currencies, why the US dollar dominates the world, why exchange rates change every day, and what all this means for ordinary people like you. This is one of the most important topics in economics because currency affects everything. Your salary, the price of food, the cost of fuel, international trade, travel, investments, and even the future of nations. So sit back, relax, and let's understand the real reason different currencies have different values. What is a currency? Before we understand why currencies have different values, we first need to understand what a currency actually is. A currency is simply a system of money used by a country. For example, the United States uses the US dollar. The United Kingdom uses the British pound. Japan uses the yen. Nigeria uses the naira. India uses the rupee. China uses the yuan. Europe uses the euro. But here's the important question. Why does paper money have value at all? After all, a dollar bill is just paper. 1,000 naira note is just ink and cotton fiber. So why do people work hard for it? The answer is trust. Modern money is called fiat currency. Fiat money has value because governments declare it legal tender and because people trust that it can be exchanged for goods and services. If everyone suddenly lost trust in a currency, that currency would collapse. This has happened many times in history. Money is valuable because society agrees it is valuable. And the strength of that trust differs from country to country. That is one major reason currencies have different values. What does currency value really mean? When people say a currency is strong or weak, they're usually talking about exchange rates. An exchange rate is simply the price of one currency compared to another currency. For example, if one US dollar equals 1,600 Nigerian naira, that means the dollar is stronger than the naira. If one British pound equals 1.25 US dollars, the pound is stronger than the dollar. Currencies are constantly being traded in global financial markets, just like stocks, just like gold, just like oil, and their prices change based on supply and demand. The more demand there is for a currency, the stronger it becomes. The less demand there is, the weaker it becomes. It's really that simple at the core. But what creates that demand? That's where things get interesting. Economic strength. One of the biggest factors behind currency value is the strength of a country's economy. Countries with powerful economies usually have stronger currencies. Why? Because investors, businesses, and governments around the world want to do business there. For example, the United States has one of the largest economies in the world. America produces massive amounts of goods and services. Global companies operate there. Investors trust American markets. As a result, there is huge demand for US dollars. The same is true for countries like Switzerland, Singapore, the United Kingdom, Canada. Strong economies usually create strong currencies. On the other hand, countries with weak economies often struggle with weak currencies. If businesses are failing, unemployment is high, corruption is widespread, or productivity is low, international investors lose confidence. Demand for the currency falls, and the currency weakens. Supply and demand. Currency values work like any other market. Supply and demand control prices. Let's imagine a simple example. Suppose millions of people suddenly want US dollars. Maybe they want to buy American products. Maybe they want to invest in American companies. Maybe they trust the US economy during a global crisis. As demand for dollars rises, the dollar becomes more expensive. Now imagine the opposite. Suppose investors are losing confidence in a country. They begin selling that country's currency. Supply increases. Demand falls. The currency weakens. Currencies move up and down every day because global demand constantly changes. Trillions of dollars are traded daily in the foreign exchange market, also called Forex. Forex is the largest financial market in the world, bigger than the stock market. Every second, currencies are being bought and sold globally. Inflation. One of the most important reasons currencies lose value is inflation. Inflation means prices rising over time. When inflation becomes too high, a currency loses purchasing power. Let's understand this carefully. Suppose today you can buy bread for $1, but next year, that same bread costs $2. Your money has lost value. High inflation weakens currencies because money buys less. Now here's the dangerous part. Inflation often happens when governments print too much money. Many people ask, why can't governments just print unlimited money and make everyone rich? Because printing money without increasing productivity destroys value. Imagine a small village with 100 loaves of bread and $1,000 in circulation. Now, suddenly the government prints another $10,000. But there are still only 100 loaves of bread. What happens? Prices rise. Too much money is chasing too few goods. This is inflation. Extreme inflation is called hyperinflation, and hyperinflation can completely destroy currency. Historical examples of currency collapse. History gives us many examples of currencies collapsing. One famous example is Zimbabwe. The government printed enormous amounts of money. Inflation exploded. Eventually, prices became absurd. People needed wheelbarrows full of money just to buy basic food. The Zimbabwean dollar became almost worthless. Another example is Venezuela. Years of economic problems, sanctions, political instability, and excessive money printing caused inflation to skyrocket. The currency collapsed. Citizens struggled to afford necessities. These examples show something important. A currency's value depends heavily on confidence. Once people lose confidence, collapse can happen quickly. Interest rates. Another major factor affecting currency values is interest rates. Interest rates are controlled by central banks. For example, the U.S. Federal Reserve, the Bank of England, the European Central Bank. When interest rates rise, foreign investors often move money into that country. Why? Because they can earn better returns on investments. This increases demand for the currency, and the currency strengthens. Higher interest rates usually support stronger currencies. Lower interest rates often weaken currencies. This is why financial markets pay close attention whenever central banks make announcements. Even a small interest rate change can move global currencies dramatically. Trade and exports. International trade also plays a huge role. Countries that export a lot of products usually have stronger demand for their currencies. For example, if the world wants Japanese cars, buyers need Japanese yen to purchase them. That increases demand for the yen. China exports enormous amounts of goods globally. As countries buy Chinese products, they need Chinese yuan. Exports create currency demand. On the other hand, countries that import much more than they export often face pressure on their currencies, because they constantly need foreign currencies to buy goods from abroad. This can weaken local currencies over time. Natural resources. Natural resources can also affect currency strength. Countries rich in oil, gas, gold, or minerals often earn large amounts of foreign currency. For example, oil exporting nations can benefit when oil prices rise. More countries buy their oil, more foreign money flows in. Demand for the local currency can increase. But there is also danger. If a country depends too heavily on one resource, its currency may become unstable. When oil prices crash, oil-dependent economies often suffer. This is why diversification matters. Strong economies usually produce many different goods and services. Political stability. Investors hate uncertainty. Countries with political instability often have weaker currencies. Wars, corruption, protests, coups, or unstable governments can scare investors away. When investors pull money out of a country, demand for the currency falls. The currency weakens. On the other hand, politically stable countries usually attract investment. That supports stronger currencies. Trust matters enormously in global finance. Money flows where confidence exists. Why the US dollar dominates the world. Now let's discuss the most powerful currency in modern history, the US dollar. The dollar is the world's reserve currency. This means governments and central banks around the world hold large amounts of dollars. Global trade is heavily conducted in dollars. Oil is largely priced in dollars. International debt is often issued in dollars. Why? Because the world trusts the American economy and financial system. After World War II, the United States emerged as a global superpower. America became economically dominant. The dollar became central to world trade. Even today, many countries depend heavily on the dollar. This gives the United States enormous financial influence globally. Why some currencies look cheap? Many people misunderstand currency values. They assume a currency with larger numbers is weaker. But that's not always meaningful. For example, the Japanese yen has a lower unit value than the dollar. But Japan still has one of the world's strongest economies. Currency denomination does not automatically determine economic strength. Some countries simply structure their currency units differently. What matters more is purchasing power, inflation, stability, and economic productivity. Floating versus fixed exchange rates. Not all currencies operate the same way. Some currencies float freely. Their values change based on market demand. Others are fixed or pegged to another currency. For example, some countries peg their currencies to the US dollar. This creates stability. But maintaining a fixed exchange rate can be difficult and expensive. Governments may need huge foreign currency reserves to defend the peg. If investors lose confidence, the peg can collapse. This has happened many times throughout history. Foreign exchange reserves. Countries hold reserves of foreign currencies, especially US dollars. These reserves help governments stabilize their economies. If a local currency weakens too quickly, central banks may use reserves to support it. Foreign reserves are extremely important for imports and debt payments. Countries with strong reserves usually have more stable currencies. Countries with low reserves can face serious economic pressure. Debt and currency value. National debt also influences currency strength. If investors believe a country may struggle to repay debt, confidence can fall. This may weaken the currency. However, debt itself is not always bad. Many powerful countries have large debts. What matters is whether investors trust the country's ability to manage the debt responsibly. The United States has enormous debt levels. Yet investors still trust the dollar because of America's economic strength. Trust is everything. Speculation and Forex trading. Currencies are also affected by speculation. Forex traders constantly buy and sell currencies, hoping to profit from price changes. Sometimes currencies move because of expectations rather than actual economic conditions. If traders believe a country's economy will improve, they may buy the currency early. If they fear trouble ahead, they may sell. Market psychology plays a huge role. Fear and confidence move markets every day. Tourism and remittances. Tourism can strengthen currencies. When tourists visit a country, they exchange foreign money for local currency. This increases demand. Countries with strong tourism industries can benefit significantly. Remittances also matter. When citizens working abroad send money home, foreign currency flows into the country. In some developing nations, remittances are a major source of foreign exchange. Sanctions and global conflicts. International sanctions can damage currencies severely. If countries are cut off from global banking systems or trade networks, investor confidence falls. Trade becomes harder. Foreign currency access declines. The local currency weakens. Wars and geopolitical tensions also create instability. During crises, investors often rush towards safer currencies like the US dollar or Swiss franc. These are called safe haven currencies. Digital currencies and the future. Today, the world is entering a new financial era. Digital payments are growing rapidly. Cryptocurrencies like Bitcoin introduce the idea of decentralized money. Meanwhile, many governments are developing central bank digital currencies. The future of money may look very different from today, but one thing will remain the same. Trust will still determine value. Whether physical or digital, money only works when people believe in it. How currency value affects ordinary people. Currency values affect everyday life more than most people realize. When a currency weakens, imported goods become more expensive. Fuel prices may rise. Inflation increases. Travel becomes costlier. Savings lose value. When a currency strengthens, imports become cheaper. Inflation may slow. Purchasing power improves. Currency movements impact businesses, workers, students, investors, and entire economies. Even if you never trade currencies, currencies affect your life daily. Why developing countries often struggle? Many developing countries face currency challenges because of weak industrial production, heavy import dependence, political instability, corruption, low investor confidence, high inflation, external debt. When countries rely heavily on imports but export little, demand for foreign currency rises continuously. This can weaken local currencies over time. Economic diversification and productivity are essential for long-term currency stability. Can a weak currency ever help? Interestingly, a weak currency is not always bad. A weaker currency can make exports cheaper for foreign buyers. This may help local industries compete internationally. For example, if a country's currency weakens, foreign customers may find its products cheaper. This can boost exports. However, if weakness becomes extreme, inflation and instability can outweigh the benefits. Balance is important. The psychology of money. At its core, currency value is deeply psychological. Money is built on belief. If people believe an economy is stable and productive, the currency strengthens. If fear spreads, currencies can fall rapidly. This is why speeches from presidents, central bankers, or finance ministers can move markets instantly. Confidence changes everything. So, why do different currencies have different values? Because currencies reflect the economic reality, trust, stability, productivity, and global influence of nations. Currency value depends on supply and demand, inflation, interest rates, trade, political stability, economic strength, investor confidence, foreign reserves, debt management, global trust. A currency is much more than paper money. It is a reflection of an entire nation's economy and reputation. The stronger the confidence in a country, the stronger its currency tends to be. And the weaker the confidence, the weaker the currency becomes. Understanding currencies helps you understand the world itself. Because behind every exchange rate is a story about power, economics, politics, and human trust. And now, whenever you see currency exchange rates on the news, you'll understand the deeper forces driving them. If you enjoyed this video, subscribe to Financial Education TV for more deep financial education content. Thanks for watching, and we'll see you in the next video.